Welcome to the presentation for flexible spending accounts. Hello, this is Rob Vermeer with Rockford Insurance. This presentation will help inform you about flexible spending accounts, or commonly called FSAs. I will explain what they are designed to do, how they work, how you benefit, and the FSA rules. FSAs help you keep more of the money you earn by paying for eligible expenses with pre-tax dollars. They do this by lowering the taxes taken out of your pay. With a flexible spending account, you can save money on out-of-pocket medical and daycare expenses by not having to pay taxes on part of your income. So let's take a look at how FSAs do this. We'll look at a pay period. It could be for any amount, but for simplicity, we'll use an amount of $1,000. This would be your gross pay, the amount you see on your pay stub before taxes are taken out. Without a FSA, taxes come out first. When you combine federal, state, and FICA taxes, most employees pay at least 25% in taxes. So for this example, 25% would be $250 paid in taxes, leaving $750. If you have a medical or daycare expense, let's say of $100, you pay for that expense with taxed income, leaving a net spendable income of $650. With a FSA, you start with the same $1,000 in pay, but that medical or daycare expense is deducted first, leaving $900. Then you are taxed on the remaining $900 at the same tax rate of 25%, reducing your taxes to $225. By deducting the money pre-tax with an FSA, in this example you have increased your spendable income by $25. In essence, you have reduced that $100 medical or daycare expense by 25%, or $25. While saving $25 may not seem like a huge amount, think about a larger expense such as braces for the kids, or many smaller expenses that add up. This could easily add up to $2,000 or more. Saving 25% on that would save you $500. So this should sound pretty good, but what is the catch or rules? First, you can only use this tax-free money in an FSA for certain eligible expenses. You also have to elect or choose how much you want to contribute to your FSA on an annual basis. During this annual period, you cannot change this amount. In other words, you cannot increase or decrease it. Then there is the use it or lose it rule. So you want to plan the amount of your annual election carefully. Let's look at these rules a little closer. There are two types of FSAs. One for medical and one for dependent daycare expenses. Medical FSAs are used for out-of-pocket medical expenses, such as insurance copays and deductibles. But you can also use them for dental and vision expenses. Dependent daycare FSAs can be used for daycare expenses for your kids. The daycare provider must be a licensed provider and able to give you a receipt for services. Contributions to an FSA are set up through your employer. You have to elect or say how much you want to contribute to your FSA through the plan year. The plan year is typically a 12-month period set up by your employer. Contributions are then evenly deducted, pre-taxed, from your pay throughout the year. So you get the tax savings at each pay period, but you can use the money in the FSA at any time during the plan year. Once you elect your annual contribution amount, you cannot increase or decrease it, except for an eligible change in status. Eligible changes would include a birth, death, marriage, or divorce. Also, if there is a change in your spouse's benefits, and if there is a substantial change in your own benefits or job, such as changing from full-time to part-time, or experiencing a loss of benefits. Perhaps the most intimidating rule is the use it or lose it. The IRS says that you do not owe any tax on any money you contribute to your FSA. However, if you don't use all of that annual election, that is, the money in your FSA during the plan year, then you forfeit it or lose it. This scares a lot of people from using FSAs. However, if you know you are going to have medical or daycare expenses, only contribute money to cover these known expenses. This is why you need to plan carefully. Rockford Insurance can help you with this. So FSAs really do help you keep more of the money you earn. FSAs are a voluntary benefit with many employers. They usually don't cost you anything. Rather, they save you money. The maximum annual amount that you can contribute to a dependent daycare FSA is $5,000. Medical FSAs have limits also that are set by the employer. While your tax savings may be more or less than 25% depending on your tax bracket, you save money on every dollar you contribute. Employers also save money by reducing matching FICA taxes. If you would like more information on how FSAs can save you and your company money, contact Rockford Insurance at 877-258-4182 or on the web at www.rockfordinsurance.net. Thank you for your time.